Okay, so now let's talk about our sale or cash discount and how the accounting entries are being done along with that. There are two important methods. One is the gross method and another is net method through which we can do the accounting entries. Now let's take the example of first scenario, gross method. Let's see that there is a company whose name is Home Depot and that sells $1,000 worth of lumber to a contractor on credit. Now these $1,000 they have sold and we are using the gross method, which simply means that now all the transactions will be recorded at a gross, which is like $1,000. So Home Depot on 1st October initially will record accounts receivable as $1,000 here, and they will record it as a full amount. And along with that, they will record the revenue at $1,000 because they are expecting that the customers won't take the discount. But what happens is like, let's see the case one. Customer come and he pays within 10 days. So the terms of conditions for Home Depot was 2 by 10 net 30, which means if the customer pays within 10 days, they will be getting a 2% discount. And customer indeed really came up and he paid within 10 days. So what will happen? A discount will be recorded for $20, which is a loss to us, and the Home Depot company has received $980, right? And along with that, there is a discount of $20. So all the discounts and losses which we didn't expected, that become loss to us. So this is a loss to us and we record it, and finally we credit the accounts receivable with $1,000, making clearing the receivable. So this was the case one. But what happens is like, if the customer come after 10 days, so after 10 days if he comes, then we don't give any of the discount to customer, and what happens, the customer has to pay $1,000. No discount is given to them because after 10 days the customer reached out to us, and if 1,000 is received and we cancel out our accounts receivable by 1,000, which is clearing the receivable, and this 1,000 which we recorded as a debit, we did credit to that, and finally we cleared this account. Now not here, we cleared this account here as $1,000. Okay, now let's see the net method. In the net method, the thought is like, customer will be taking the discounts. So historically, if the customer has taken the discount, so Home Depot will record it at $980 because the customer will be taking 2% discount on $1,000, right? So what will happen is like, in the net method records the sales and receivable at the net amount. So on 1st October, we will be recording accounts receivable as $980. This 980 is net amount, right? Because record only the expected cash, which is net of discount. Similarly, we will say our revenue is also $980 because the customer will be paying only that much, right? Now what happens? The customer reaches to us and pays within 10 days. What we expected is happening in reality. So simply we will be receiving the cash of $980 and we will be cancelling out this accounts receivable as a credit, which is $980. So no further entry is needed because what we thought is actually happening. But what happens in the case B is like, customer don't come in 10 days but he come after 10 days. So in that case he has to pay us $1,000 and the customer paid us this $1,000. But what happened? Initially we expected that he will be paying us $980 and he will be taking the discounts. But in actual, he has paid us $1,000 because he is not availing the discount because he is paying after 10 days. So in that scenario, what will happen? We will say there is a benefit to us for $20 because we have not planned for this $20 in our revenue, right? So we will say this $20 is a sale discount benefit. That's the reason we are crediting it, because all the income and gains are credited. And accounts receivable is credited by 980 because we created our accounts receivable debit 980, and when we receive the money we need to credit it here. So this was the overall example of understanding. Now let's see the textbook definition for this cash and sales discount. So textbook simply says that this method of company usage depends upon the historical experience. If the company thinks majority of its time the things are recorded at gross and the customer don't take the discount, they book it at a gross level. If based upon experience they think company the customer takes the discount, then they book it at a net value. Now if the gross method is used, then what happens? The initial entry what we saw when the gross method was used is recorded as 1000. So what they are saying, sale and accounts receivable are recorded at the full amount. The rationale is simple, company is expecting to collect the full price. Now if the customer come and he takes the discount because he has paid within 10 days, so if he has paid within 10 days it means that they have taken the discount. Now if he takes the discount, we thought initially that we will be receiving $1000, but this is not going to happen. So the sales discount entry we have to pass of $20 because that is a loss to us. So the discount taken is debited to the sales discount. And the rationale is simple, the revenue is reduced because a less cash was collected than originally billed. Now what happens in the second case, which is like if the discount is not taken, payment after 10 days, initially we thought $1000 will be received from customers and customer is paying after 10 days, so he pays us $1000 as well. So there is no difference of what we thought, only the collection of cash is there and clearing of accounts receivable is there, and no adjustment to revenue is needed as the full price is received from the customer. Now let's see the net method as well. In the net method, what we assume is that customer is taking the discount, so the recording is being done at a net amount. Let's see the initial entry. So in the net case we knew that customer will be paying $980. So the sale and accounts receivable are recorded at the net amount, which is like gross minus discount. And the rationale for that is AR is stated at its net realizable value from the start. It's like NRV is being taken. Now what happens, customer come and he takes the discount. So we thought we will be receiving $980 and customer come and he pays $980. So it's a clear cut receivable case where 980 is received. Rationale is simple, no adjustment is needed because what we expected we collected that. But what happens is like customer don't come in 10 days, he come after 10 days. So in that case we can simply say that we expected 980 but customer came after 10 days, so we can say the customer will be paying us $1000. So that $1000 he will be paying, an additional $20 we are receiving against our expectation. So we will be saying this is not lost, this is our earned या फिर additional I can say discount. So this additional discount is credited to the sales discount and this is a benefit to us, which was $20. And the rationale is simple, the extra cash received is recorded as additional revenue because customer failed to take the discount, he didn't took that discount.